There's always a saver, there's always a banker, and there's always a borrower. But most Americans have never been the banker. We've all been the saver, we've all been the borrower. When you are all three players in a money game, it gives you some unique advantages. And so now, if we need to go purchase something, finance a vehicle, instead of letting that principal and interest just leave the family's wealth forever, which is what happens, we now create contracts and relationships within the family so that when financing needs come up, and they will for all of our children, for grandchildren, that's essentially cash flow for the earlier generations. And then we can work out the deals to where we will transfer that wealth back to the individuals via the death benefit of the policies.
This is the Asset Protection Show. Expert strategies by attorney John Skabelund.
Welcome to the Asset Protection Show, the podcast dedicated to not only protecting your assets from lawsuits and creditors, but also protecting your legacy. After all, what we do isn't just for ourselves, but to create generational wealth. I'm your host, John Skabelund. Life insurance has asset protection value, and it can be a powerful investment tool. However, it must be done the right way. Discover today how to invest in life insurance correctly and avoid common mistakes. Today's guest is Kyle Fuller. Kyle, welcome to the show. It's been great to know you for several years now.
Love it. Thanks for having me, John. It's an absolute pleasure to be here.
Well, audience, Kyle is the CEO and founder of Factum Financial. You have over 11 years of experience in insurance. I know you guys service clients in all 50 states, but tell my audience about yourself, Kyle.
Yeah, I got into this industry 11 years ago, just looking for an alternate way for Americans and families to build wealth with more certainty, more self-reliance, and insurance definitely struck those chords. And so currently we teach a lot of wealth building utilizing life insurance as a foundational asset. Like you said, we have clients in every state, and we have the exclusive educational rights to teach financial management and life insurance to the largest real estate company in the world, which is Keller Williams. So we feel like we've got some pretty good stuff. We enjoy working with the families that we serve. This is more of a mission to us as opposed to just a business.
Tell us more about that mission. What do you mean by that?
So, John, early on in my life, when I was 16, my grandfather set me up with a Roth IRA. So early on, he kind of instilled those ideas of, save early, save often, invest early, invest often. And, if you kind of go down that route, you're going to be able to retire early. So for me, retiring early was the greatest thing ever. I didn't really enjoy going to high school at the time, and I didn't really enjoy working because I hadn't found my passion. So retiring early sounded like a dream come true. Well, fast forward to 2007, I graduate high school. 2008 rolls around, the market crashes, and I lose 40% of the value of that Roth IRA. And the financial advice that was given to me was, don't worry, you're young, like you'll recover from this. And so my thought process there was, well, if I'm 58, you can't tell me the same thing if this happens in the later stages of my life. So it kind of set me off on a path to look for something else out there that would provide more options and more certainty. And as I went along and found, the infinite banking concept, whole life insurance, which is what I've built my financial portfolio on, now what we teach families how to win the money game is so fulfilling that I would never use the words retirement for me ever again. Our passion is to help families and businesses build family banking operations, which becomes a very spiritual conversation as well. It really fulfilling. And so that's what we call more of our mission, is to help impact middle America with how much money they save, where they save it, bringing families closer together around their money at the same time.
No, that's really helpful. And again, I have always appreciated how you guys have a very holistic plan to your approach with clients and how passionate and dedicated you guys are. So thank you for that. Well, you use some words that I just want to back up, make sure the audience understands. So first of all, define for us what you meant by infinite banking. Is that the bank on yourself concept?
That would be very similar. So there's been some spin-off versions, but if you want the original source where all of these ideas and concepts came from, you want to grab the book by Nelson Nash titled Becoming Your Own Banker. It's a big black book. You can't miss it. It's 85 pages long. Every other concept, the bank on yourself, all of that has stemmed from the book, Becoming Your Own Banker, Unlocking the Infinite Banking Concept. So that's where I'd go to get the source. And first and foremost, that whole concept, John, it is a mindset and a lifestyle around how you view money flowing through your life. A lot of times people reduce it to, I own life insurance and I'm leveraging the cash value, like I'm doing infinite banking. We would call that like a stage two. That's like a wealth builder conversation. Whereas what I do is called infinite banking, and it's more of a lifestyle and a process than it is any type of product.
No, that's helpful. So why don't we start big picture? So you touched on something there for a moment that you said level two. So tell us big picture, how does life insurance fit into a person's wealth or assets, and how should they be looking at life insurance as a product? Is it an investment? Is it savings? How do you guys approach?
If you break down the benefits and the characteristics of life insurance, I don't think most people, if they have good education around it, would ever classify it as an investment, right? Investing is going to be taking some type of calculated risk in something you know and understand, but that risk portion is always there. I could lose money when I'm investing. And that's an acceleration conversation. Life insurance, specifically whole life, should exist at the exact opposite spectrum of the money game. It's there for guarantees and certainty. Much like you'd build a foundation of a home, if you don't have the right foundation built, it doesn't matter how pretty your investing strategy looks, how good your gross returns are. If the right foundation is not there, you could be wiped out with one economic event. And so a lot of times people miss the power of life insurance because they're looking at it as an investment, whereas major banks, corporations, my family now, we position life insurance at the very base of our financial plan as more of a saving strategy. And it really has nothing to do with investments or rates of return.
That's helpful. So what else is included in that foundation of the financial plan that you work with your clients on?
So we kind of break wealth, John, into two categories, foundational and acceleration. Now, the interesting thing is if you look at certain key components of the wealth building game, everyone's got to have good financial education, or they should be investing in it. And when you have good financial education, it brings awareness. And when you're more aware of what's going on in the money game, you can make better decisions. So the big three I'd put at the base is education, awareness, and a really strong saving strategy. Everyone needs those things. And as you build more of that foundation, you're going to have certain insurances in place. You're going to need to know your debt strategy, understand taxes, have good asset protection, get your estate plan in order. All of those elements we'd call foundational. Now, whether you make $50,000 a year or you're making $50 million a year, we all have the same foundation when it comes to wealth planning. You've got to have all those elements. Otherwise, as you know, in the line of work you're in, you could be one event away from losing what took you 10 years to build because you didn't have the right protection entity structure in place. So the foundation is interesting because it should look the same for all of us. On the acceleration side, that has to look wildly different for you as it does for me because we both want different things in our life. You have an idea of what you want your life to look like, and that would be different than mine. And our investing strategy has got to support what that ideal life looks like for us, which is why we'd say have a tough foundation and have a very intentional investing strategy that fits your lifestyle or mine.
So let's talk about that a little bit further. So you shared that you are exclusive to Keller Williams Group, and that's powerful because obviously that group is used to building their wealth through real estate. So talk to us about what would a particular real estate investor or business owner or high net worth individual look like? I recognize that it's kind of hard to generalize, but are there common components that you can speak to?
Absolutely. So one thing that Keller Williams did that's really, really fascinating, and I love this, that they've essentially built what's called a family office for all of their agents nationwide. And a family office is a team of professionals that was usually reserved for families that have like 50 or $100 million net worths. And these professionals would work solely for that one family to make sure that their wealth is perpetuated, protected, and growing. And so they have different professionals in this KW Wealth community around taxes, estate planning, asset protection, you name it. They brought our company in to help facilitate the financial management conversations and all the life insurance for their family office. And so when we are working with real estate professionals or investors, high net worth individuals, we come in to help individuals like you, John, be as efficient with the money flowing through their life and how much of it they're keeping and protecting and then passing on generation to generation. So we're the exact opposite of the acceleration conversation. Would you agree that making money and keeping money are very different skill sets?
Absolutely. Yes.
Most of us can be pretty good, especially in the United States, where we have so much opportunity to generate income. But having one of the highest incomes in the entire world, which we do, does not necessarily translate to more Americans having more access to the money flowing through their life. Most Americans keep on average 5% of what they're making, whether they're making 50,000 a year or $5 million a year. The savings rate is not really affected by how much income we have. So we were brought in and we help top professionals keep more of that money they're already making. And we show them how to be as efficient as possible with just storing it in slightly different environments that they were typically taught to save money in.
No, that's helpful. And so, why is life insurance such a powerful tool in that regard?
This is where education is so important because a lot of people, when they're looking at life insurance, they're going to look at it and they're going to say basically three things, John. I've seen these products, they got a low rate of return, they're expensive to own, kind of making it the worst investment of all time. And life insurance is not an acceleration asset, it's a protection asset. So you got to put it at the foundation. And when you can see the characteristics that are in that asset, the benefits, if you will, what you'll find is life insurance is a very liquid, safe asset. So we'd never classify it as an investment. As soon as that light bulb goes off, people understand this is more like a savings vehicle than anything. And once you see it in that light, there's very few savings environments that can even compete toe to toe with the benefits, let alone like a return standpoint. So most of my long-term savings, John, goes into whole life insurance because I'm getting benefits there that I would never get in a commercial bank, a CD, actual cash in my safe or under the mattress, precious metals. The benefits of life insurance just cannot be beat by other liquid safe assets. And one of those is, like you said, privacy and asset protection.
So, why is life insurance such a safe product, and how is it so much more valuable or has greater potential than some of the other safe investments that we're taught that are safe, such as precious metals or real estate or things like that? Can you contrast life insurance and help us understand that a little bit better?
Absolutely. So when we're going to classify investments versus, let's call it security. So we have money that we save in like a checking or savings account. And the reason we do that is because it needs to be liquid or accessible and it's got to be safe. Like my Roth IRA that I lost money in 2008. See, if that was a checking account, the amount of the checking account would not have gone down 40%, right?
Right.
So there's difference between why you'd hold money in liquid safe assets and then the other piece is I want to accelerate and make more money. Well, when you go to the acceleration piece, you introduce more risk. And so those two things are exactly opposite. You need safe places to store money, and then you need places to invest money. And life insurance exists in the save or hold category, not the investment, in my opinion. So once it's there, the benefits that I would get from precious metals, CDs, liquid, safe, high yield savings accounts, checking accounts, typically we're always getting two or three benefits. You can have a conversation with me about this. It's going to be liquid, it's going to be safe, it might have some inflation protection. Sometimes we get privacy, like if we're holding actual cash in a safe, we're not earning any yield on that. Like it's not earning 5% at some commercial banks, right? So we're always in this state of trading off benefits. Well, when I go to life insurance, which is actually where a lot of major corporations and major commercial banks store a lot of their long-term wealth, especially the liquid one, the liquid part of their balance sheet,
Mm-hmm.
they go to life insurance because of the benefits that they receive. So my whole life policies that I've built my family banking business on, that's the foundational asset. You get guarantees in a contract for your entire life. I'm a big fan of guarantees, especially if they come in a contract. All of my cash values are liquid. They are completely safe. They are growing every single day I'm alive. It creates legacy, transfer of wealth for future generations. So I'm getting a number of benefits in one location with guarantees that I do not get in any other location. And that gives me a few advantages in the money game.
But knowing what I do about life insurance, I know that not all policies are the same and not all of them have no risk, as you say. So talk to us about that. Describe what kind of policies have no risk because a lot of them do.
Yeah, and you have to be real particular with the policies you're buying. So, I would go out on a limb and say about 95% of the life insurance that's being purchased in the United States is not going to do what we're describing on this call today. So, not all life insurance is created equal, and you have to just understand the insurance world. Everything in the insurance world is a trade-off between risk and cost. So a lot of times we hear things like term is very cheap and permanent life insurance like whole life or universal life is expensive. But everything in the insurance world is priced perfectly for the risk. So term insurance will have a lower premium because there's a 1 to 2% chance you're going to use that in the term period. Now, I carry both. I have term insurance and I have whole life. And you buy them for very different reasons. Now, the benefits that I get with the whole life is it comes with the strongest guarantees, meaning that product was built to last through any economic environment. And that's why we'd say it's a very tough asset, and that's why I want it at my foundation. Now, you can buy other policies like a universal life, variable universal life, indexed universal life, John, that will have more of an investment component built into them. But
Hmm.
now we're starting to separate the safety and the guarantees from that product, and we're introducing a little more risk to the consumer who's buying it, but you do get a slightly higher potential upside on the growth. And so that's where a lot of times all these conversations come into the same place, and people are like, life insurance is life insurance. It's no different than saying like a commercial real estate building versus a single family home that's both real estate, but you buy them for very different reasons.
That is helpful. Now, let me ask the obvious question, and that is it's great that the life insurance that you use is safe, but and I understand, I want to be clear on this that it's not an investment. Your approach is it's savings, but I also want that money to grow. So that's the problem of not sticking $250,000 sitting into a typical savings account that's earning less than 1/10%. So, what
Yep.
kind of growth potential is there in the life insurance product you're describing?
Great question. And you want to make sure that you're using insurance teams that use certain software. I would say one of the best softwares most life insurance agents should be using is a software called Truth Concepts. I would say whole life insurance is one of the most misunderstood assets that people buy. And when it comes to the yield or how to calculate the growth on those,
Hmm.
that is probably the most misunderstood benefit in life insurance, John. And so you want to have certain software that can help you calculate the true net internal rate of return on a policy. Now, you kind of have to look at it over a long period of time, but the life insurance that I've owned over 10 years now, if I keep those policies 20 years, 30 years, 40 years, the guaranteed rate of return in those policies is going to be around 3 to 4%, but that's a net return, meaning net of fees and net of taxes. So I've got a video on my courses because this is one of the most commonly asked questions that'll show you if I leave my cash in a high yield savings account or a CD, I would have to earn between 6 and 8% gross to match what I'm getting on a guaranteed basis in my life insurance contract. Now, when people can see that comparison, it's very difficult to beat the long-term rate of return on life insurance. And we're not even investing yet. That's just where we're holding cash, which for me makes me a tougher investor because I don't look at investments that produce 7 or 8% anymore gross because I'm getting that in a life insurance contract on a guaranteed basis.
And help me understand why. is 3 to 4% in a life insurance equal or equivalent to 6 to 8% in a savings account? Help me bridge that gap there.
Yeah. So I'll give you a quick story. A couple years ago, I was at Chase Bank because we do a lot of private vehicle financing in our family now as part of our banking process. So we don't let principal and interest from vehicles our family buys. We don't let that wealth leave our family. That stays in the family generation to generation. This goes back to that mindset of, thinking like a banker versus thinking like a business owner or investor. So anyways, I'm in the bank with a cashier's check and from a policy loan I had taken, and I saw that they were advertising a CD, a certificate of deposit, another liquid safe asset that was paying 5%, but that's a gross rate of return. So if they were saying I got to put a certain amount of money in the CD and over a 24-month time period, they were going to pay me 5% gross. Well, the
Mhm.
5% is before their management fee, and they had a 1.5% management fee to grow that money. So automatically, you're not earning five, you're earning five minus their management fee. So what you're actually walking away with is not actually five, that's the gross. You with me on that?
Yeah. Okay.
Now, if I'm in a 30% tax bracket, that growth in that CD is still taxable. So I'm walking away with the 5% gross minus the management fee minus my taxes. So when we look at life insurance illustrations are showing you a net value, not a gross value.
Mm.
So it's the true number that actually belongs to you. This is no different than someone saying, I made $200,000 last year gross, but because the taxes I paid, my net was only $80,000 or whatever it was, right?
Well, you raised two great topics. So, first one I want to touch on is the tax savings or tax advantages of life insurance. Describe to us, why are you not considering the tax rate of the individual against the life insurance like you did the CD?
So when you are funding life insurance, I'm going to fund those policies with after tax dollars, very similar to how you'd fund a Roth. Like a lot of people will fund a 401k or an IRA and they get the tax deduction going in.
Hmm.
But I have a lot of clients in their 70s that are like now very hesitant to touch those IRAs that they've been funding for a long time because now it's time to pony up and they don't really want to take that tax hit. So that's why a lot of people will look at and saying, if I think taxes are going up, I'd rather pay taxes now and put it into an investment like a Roth. Well, the tax treatment is going to be very similar with life insurance. You don't get a deduction going in, but all of the growth, the death benefit is not going to be subject to income tax. So it does have some long-term taxable advantages. And this just comes down to you need the right wealth team, the right plan, because not everyone thinks like that. Now, for me, I like knowing that I'm paying taxes at a known rate today.
Hmm.
All the growth inside the policies that I own will never be subject to that tax ever again.
That's helpful. And then the second point you raised is how you went into the chase and you said that in your family, you're actually buying vehicles and financing them through your life insurance. Did I catch that right?
Yes, it's a principle called family banking.
So talk to us more about that.
Yeah, so this is an interesting one, John, and this has become a very spiritual conversation for our family. So, our family is extremely important. We're big family. I'm a big family guy. You know that. So is Joe, my brother, who helps me build all this. And you know, money is a taboo subject in most households. At least it was for me growing up. And now we have this family banking system where our family operates closer, well, in a process we call being interdependent. We're all doing our own thing, but we have this private pool of capital in these life insurance contracts that when we need to finance something, we do not go to the banks and pay them interest. We will handle all of that internally using our own resources. And this is now getting into the concept of infinite banking. You see, there's always a saver, there's always a banker, and there's always a borrower. But most Americans have never been the banker. We've all been the saver, we've all been the borrower.
Mm.
When you are all three players in a money game, it gives you some unique advantages. And so now, if we need to go purchase something, finance a vehicle, instead of letting that principal and interest just leave the family's wealth forever, which is what happens, We now create contracts and relationships within the family so that when financing needs come up, and they will for all of our children, for grandchildren, that's essentially cash flow for the earlier generations. And then we can work out the deals to where we will transfer that wealth back to the individuals via the death benefit of the policies. That's a 3-minute version of how family banking works. There's definitely some rules, contracts that you're going to want to have. What I'm not saying, John, is go out and start lending money to family members who are not educated, without contracts, without the right relationships. That's a recipe for disaster.
Right. No, I wholeheartedly agree with you there. But let's make sure we understand the bank on yourself or infinite banking concept a little bit further. So you talked about vehicles. I assume the same concept can apply to education, real estate, businesses. What are its limits? Talk to us more about what does this look like in daily life?
Yeah, there's a reason it's called the infinite banking concept because once you get the basic mechanics, which is when you start storing wealth in environments like life insurance that are going to bring you more benefits in one location, that really makes you really tough foundationally. And now, once you're in that position, now we can go out and invest, we can run our business, but instead of using someone else's banking system to help us operate that, we're just going to use our own. And this is more of a control conversation. And I would say, John, this is where the paradigm shift has to happen for people because you and I were probably brought up and raised. If we understand, Robert Kiyosaki's cash flow quadrant, people think like employees,
Mm-hmm.
self-employed individuals, business owners, or investors. And we've all been taught if you want to win the money game, get into business or become an investor. There's advantages to doing that. But what I had never learned, and I learned this 11 years ago from an orthodontist of all people, he had become a private banker who was then financing his investments and his business. And when you get to be that extra player in the money game, it gives you some serious advantages. It requires a mindset shift, but there is no limit to how banks help us operate from any investment, any business, any consumer. And so there is no limit on what you can use these policies for. I use them for family banking. I use them to make large purchases. I use it to make my investments. There's no different in what I'm doing than the average American. It's just where my family holds and stores wealth is remarkably more efficient than most American families.
No, that's fantastic. You remind me of an uncle of mine who was vice president of Wells Fargo when he retired, and he shared with me when I was very young. He said, John, those who understand interest earn it. Those who do not understand interest pay it. And it's always kind of stuck with me. So I appreciate that. Let's get into the real mechanics of how this works and what it looks like. So I understand, and the myth or perception is that it's hard to get money out of a life insurance product and that it often takes several years. So walk us through how easy is it to access and what are the mechanics involved here?
Yeah. And so this is why having the right relationship with a team that really lives and breathes this. There's a lot of insurance agents out there that will kind of tell you like, oh, I've heard of that concept. I could help you, buy one of those types of policies. You really have to make sure the policies with the right carriers, it's designed properly, and you have a relationship with someone that's done what you're trying to do. It's very important. And so, if all those three things are in place, most likely you're having conversations and you'll know all of this before even buying the product, which is going to be very helpful. So, it is no different than me putting $10,000 a month or a year into a savings account and then going to that savings account and then using that for whatever in life. I'm just directing that in the form of premium to an insurance policy. Now, when it goes in there, it creates something called cash value. It's not actual cash, it's called cash value, but you have some options with that. You could surrender some of it or take it out and actually use it. What I prefer to do is I'll call up the insurance company and say, I've got $100,000 of cash value in my policy, earning, 3 to 4% net every year. I would like to take a policy loan from the insurance company's general portfolio. Insurance companies lend a lot of money. And so my cash value will stay in the policy, earning that guaranteed interest rate. I use a policy loan from the insurance carrier. My cash value is collateral. I take that money and I go make an investment. Now, you are charged an interest rate when you do that. But the trade-off is all of my cash in my policies is continuing to earn that uninterrupted growth. And that's where if you give this 5, 10, 15 years, you're going to see this exponential growth on your savings, where most people, John, are in a state of constantly interrupting any growth that their savings is earning because they just don't have it in the right environment.
That's helpful. And again, I've appreciated how you have mentioned that this really is a mindset or shift in your thinking. So, talk to me about who is a good fit for this kind of savings, and how do you help people?
Yeah, that's one of the things I love about my industry, John, is I'm in the industry of certainty. Like we have a lot of real estate professionals for clients, and something I do not envy about the mortgage world or the real estate world is interest rates are constantly fluctuating. Is now the greatest time to buy? Is it 6 months ago? Is it 6 months from now? That would give me anxiety. Being a financial advisor would give me anxiety. If I lost someone 40% of their value, I don't know if I could sleep at night. That's a hard one for me to swallow. In the world that I'm in, every single American is a candidate for my business because every American needs to store cash somewhere and every single American will pass away. It's kind of an interesting industry to be in. And the only trade-off you're getting is every day you wait to buy insurance, you get a little bit older, and that's where you get dinged. So if you wait 6 months, 1 year, 2 year, the amount of death benefit it's going to purchase you goes down slightly. And this is why a lot of people will start buying insurance on their kids because it's the earliest, best time to start a compounding environment for their money. And it's also the cheapest time to insure. And so everyone is a candidate if they are looking for a more efficient place to store cash. And every single American will pass away. It's just we do not know when. And so that's my answer to that is it's kind of a very broad thing. Now, you have to be willing to learn and change some of your financial habits if you want to be successful. And that's what I would say would eliminate a lot of people from this is they don't want to do the work and kind of get better with the money game. A lot of people are just looking for that magic pill. I don't want to think about my money, and I definitely don't want to get better with it. And we really can't help those individuals.
Explain that a little bit more, though. So, what does a person have to change in order for this to work for them?
So if we just look at the American landscape, we make so much money in this country, John, but our savings rate nationally is less than 5%. So a lot of people are like, hey, I like this. I want to do this, but I can't. We're barely saving any money now, so they can't contribute to a life insurance contract, which typically requires an ongoing stream of premium, right?
Right.
And so the last thing you want to do is commit to a policy that you don't have the right financial management habits to keep going, and then find yourself in a position 3 or 4 years in where you're like, an event happens in your life and you're like, I can't pay for this thing anymore. And that's when it becomes an expensive use of your money. So you got to build the plans right from the get-go. They got to be comfortable and affordable, but you have to have the right savings habits, financial management habits in place. Otherwise, you just won't be that successful with anything that we are teaching. And that applies to investing too. The reality is there are Americans out there who are just going to say, John, I don't want to do that work. And my advice for them is if you're going to spend everything, just at least go have a good time. You won't be wealthy, but at least enjoy it. There's nothing wrong with that if that's the path you want to choose, but you won't be wealthy.
That's helpful. So, talk to us a little bit more about what you raised there about age. So, obviously, it's better to do this earlier than older, but what about concerns about insurability? There's a lot of my clients that tend to be, by the time they are working with me, they often are older and may not be insurable. So, how would that work in this life insurance product or savings tool?
That's a great question. And this is where going back to education is so important. If people start looking into this and they say, I really like these benefits, I like this idea of privacy, guarantees, certainty, they like all that. They like the idea of the infinite banking concept, but maybe they have heart issues. I have clients in their 70s that have, medical issues that they are uninsurable. Well, it doesn't mean you can't do this system. I own policies on my parents and my mother-in-law. So my wife and I are the owner and we're the payor, but it is on the life of a different individual. Now, you have to be able to prove insurable interest. So you can't just go out and buy life insurance on anyone, right?
Right.
I also own insurance on my kids. So I own policies that I'm using the same way that we've been talking about. It's just not on my life. So a lot of times I'll have a client who's uninsurable that wants to do this. They could insure and own policies on their kids, a business partner, a spouse. And so just because they're uninsurable does not mean they are eliminated from the potential of owning life insurance. It just may not be on their life.
Helpful. The other thing that I hear frequently is that this is a big investment that you need to have quite a bit saved in order to invest in this policy. Is that true? What kind of investment does someone need to have?
Yeah, this is another interesting one. So if you're learning about life insurance, something very important to learn with these policies is the more premium you pay, the more cash value you will have. Premium equals cash value. So it's just like depositing money in a bank. The more you deposit in, the more you have access to. Now, when you're starting, this is why you're going to want to have some good, tough money management habits going in. My first policy I started was 10% of my gross income. That was a comfortable, affordable number. And for me, 11 years ago, John, that was $8,000 a year is what I started my first policy with. And so we have 18-year-old clients that will save $100 a month and just get it going. We've got clients that do $1 million a year. It's completely relative to the individual. And so where I'd say people go wrong is they probably commit too much premium without understanding the mechanics and what their options are. And they're not thinking about things like cash reserves, liquidity in case of financial events. And that's when they can kind of get themselves in trouble. So the more time and education you have around these assets, typically what we see is the more of it people end up wanting, but it's going to be a progression. Kind of like people that own 30 rental properties, they don't go out and buy all those in one go. They usually start with one. The second and third is a little bit easier, and you kind of build your portfolio over time. It's going to be the same way with life insurance.
That's a great analogy. Are there any benefits to business owners? Is there something that can be done through a business that would be helpful?
Yes, absolutely. So if we understand that life insurance is just a really tough asset, a place where you need to hold cash. Business owners need efficient places to store cash, just like consumers. The extra advantage a business owner would get is not only can they store business capital here to use to run their operation, but they can also have it be insurance for very key individuals. And that you can use these policies for types of bonuses, golden handcuffs, if you will. Hey, if you stay and work with me for 10 years, I'll give you this insurance policy as long as they're taught how to use it. So you can use it for key partner insurance, defined benefit plan. So kind of like a deferred compensation, like a 401k, you just have more flexibility with these.
Hmm.
So I own these on my business as well to have efficient places to store cash, but also to protect very key individuals that if something happened to them, I would feel it financially big time.
No, that's helpful. So, Kyle, what are the risks? What should someone know before they make this investment? Or, again, excuse me, the savings plan, because it's not an investment, but before they put their money into this life insurance policy, what are the risks that someone should be aware of?
Yeah, you want to have the right carriers with the right policy design for your unique situation. And then you want to have the right relationship with an agent that's going to go the distance with you. A lot of people that work with us, they know that I'm in this for the next 70 years. There is no retirement goal. So I'm going to be here for them, their children, their grandchildren, right? I've got a lot of runway in this business. And so the risks would be starting with too much too soon and not having the proper education going into that. As long as you can get through the first 2, 3, 4 years of that policy, you're going to be totally fine. Just don't bite off more than you can chew early on. That's when it becomes that expensive mistake. And I would call it an investment there. If they're putting money into something they don't understand, that's not the way to purchase this. So Just don't start with more than you can continually put in, and make sure you have enough education going into that to where you are very comfortable with everything going on. The more education, the less risk you're going to feel in that asset.
And what you're alluding to in part there is obviously this is a contract you're making with the life insurance company. You got to be able to make the insurance policy premiums, right?
Yes.
Yeah. You keep mentioning a word that I want to come back to, and that is tough money. Talk to us. What do you mean by tough money?
Yeah, this is one of the things that we've set out to do as a company. It's part of our mission too. We have so much income in this country. We have so many people that we work with that make phenomenal amounts of money, but it does not translate to wealth. And so our Tough Money curriculum is a financial management educational course that comes with a workbook and 25 steps to know if you have what's called tough money. So we're all going to experience events in our life, John, and events could be recessions, lawsuits, accidents, divorces, deaths, you name it. Let's go back to 2008. When 2008 happened, that was an event, and it obliterated my parents financially. I mean, they were crushed in 2008. But there were families at the same time that were able to survive 2008, and not only survive it, but they came out thriving financially. Because when real estate went at a discount in 2010, 11, and 12, they had enough cash reserves or liquidity to go buy when things were very low. Same event affects families very different. So our tough money curriculum is some components around how much are you saving? How much cash reserves do you keep on hand for opportunities and events? Do you understand your debt to income ratio? Do you understand your investment philosophies? There's a number of components that go into that tough money effect, and it comes with a workbook because everyone's financial journey is a little bit different. And the purpose of that is to make sure when you go to bed at night, you are so confident that your wealth plan is really tough. Nothing's going to bring you down. And it's really easy to win the money game when you can't lose because you're tough. Then it's just a matter of how big do you want to scale that. And that's exactly what we do with Keller Williams. We don't touch their investing conversations around real estate. We're there to help them facilitate the best financial management and put the toughest asset, which we'd call life insurance, at their foundation because it's going to help you be a better business owner, be a better investor. And so it is all around your money management habits.
No, fantastic. Well, this has been a great conversation, Kyle. We really appreciate your time. Anything else you feel like our audience should know about the bank on yourself or infinite banking concept, life insurance generally? What else have we not touched on that you feel like before we end today that we should be aware of?
Yeah, I would say it always is going to come down to education. So make sure you've done enough research, you've talked to a few teams, you really understand the relationship that you need to have with a life insurance agent. You understand the products you're looking at. And whoever's helping you is building you a policy that's designed to fit your unique goals and vision. Unfortunately, John, most of the families that we serve, because we do complimentary life insurance reviews, when we see the type of insurances that they have, a lot of times the clients we're coming across do not understand what type of policy they've purchased. They can't remember why they bought it. And when we say, who's your agent? A lot of times the response is, I'm not sure, or they're not even in the industry anymore. That's just a recipe for disaster. That's when life insurance becomes what we call very low value spending. You're
Mm.
spending money on this contract that's not going to do what you want it to do. And it's you got to have the right specialization, the right team. And so I would just say seek out people who are actually doing this. They got to be living this. They need to be all in. And I would be asking them, can you show me some of your policies as well? You might be able to teach me, but I kind of want to know that you're actually doing this. It would be important to me, John, that I knew you had a good asset protection plan in place if that's what you're doing for your business. I would want to know that. Much
Oh,
like
excellent point. Yeah.
if you're teaching real estate, I'd want to know you own real estate, right? If you're telling me to invest in it. Yes. You
Right.
probably won't find people who own more life insurance than we do on our team, John. We're obsessed with this stuff. And that's the person you want in your corner on your wealth building team.
Oh, very helpful. So, Kyle, how can someone contact you if they would like more information?
Yeah, I'm local here to Arizona, but we have clients and we do business all over the country. And so they can go to our website, factumfinancial.com. They can see our whole team there, about us. They can send me an email directly, kyle@factumfinancial.com. They can find us on Facebook. We're pretty much all over the place at this time. They could reach out to you and you can make the introduction for us. And so we know you well, John. Whatever way is easiest for them. We are here to serve. We're going to be here for a very long time. There is no plan to sell Factum. It's going to be a multi-generational operation that serves families for generations to come.
Oh, that's great. Thank you so much. And listeners, I appreciate how Kyle has brought up the virtual family office, or that concept. I'd encourage you to listen to episode 8 with my interview with Jeremy Leder, where he talked about the family office concept as well. So with that, we'll wrap up today's episode. Thank you so much for joining me. My goal with this podcast is to give you great, actionable content that empowers you to protect your assets that you've worked so hard to build. And again, life insurance is a great product to do that. To help me do that, I'd love to hear from you. What topics are on your mind? Are there specific strategies or legal questions you want me to cover? Are there particular investments like life insurance that you would like me to discuss? Please leave a comment and let me know. If you found today's information valuable, please consider sharing this episode with someone who might also benefit. Word of mouth is the best way for this show to grow. Finally, if you have a moment, leaving a quick rating and review on your favorite podcast app would be a huge help. And it makes a real difference in helping others find the show so that they too can learn from an asset protection attorney about how to protect their assets and preserve their legacy. Thank you again for listening. Until next time, stay protected.
You've been listening to the Asset Protection Show, expert strategies by attorney John Skabelund. For more information, go to assetprotectionshow.com.
This content is legal information only and not legal advice. Viewing this content does not create an attorney-client relationship. Mr. Skabelund is admitted to practice law in Arizona, and he may be reached at ultimateassetprotection.com.